Welcome back to Gold Fox Wealth. Let's talk money. You manage a $2 billion family office. Your only job is to not lose it. And right now, you are close. It is 6:14 in the morning on a Thursday. You are sitting in an empty office on the 42nd floor of the San Francisco Financial District, looking out at a dense wall of coastal fog. On the desk in front of you sit a legal pad, an iPad showing a live Bloomberg Mac 3 portfolio risk feed, and an iced sea salt caramel matcha latte from Jumbi that cost exactly $9.75, slowly sweating onto a leather coaster. The number on the terminal screen is $2,140,500,000. That is the total assets under management for the Harrison family. They made their money in Midwest logistics and commercial real estate 3 generations ago. You did not make this money. You do not own this money. You are the chief investment officer of their single-family office, which is a very polite, very well-paid way of saying you are the guard dog. You take a sip of the matcha. It is completely quiet. Most people look at $2 billion and see infinite possibilities. They see yachts, they see political influence, they see a number so large it bends the physical reality of the world. You look at it and you see math. Brutal, unforgiving math. Here is the architecture of generational wealth that nobody talks about. There are 14 living beneficiaries in the Harrison Trust. Add up the quarterly distributions dictated by the Delaware Dynasty Trust, the upkeep of 7 primary estates in Lake Forest, the family foundation's mandated giving, and the 36 basis points of operational drag it takes just to keep the office lights on, and the family burns exactly 4.14% of the principal every year. Inflation eats another 3%. So before you even walk into this building, before a single trade is executed, you have to generate a 7.14% return just to stand completely still, just to not be the person who lost the fortune. You are not trying to beat the market. You are trying to outrun the mathematical decay of an empire. And lately, the margin of safety is evaporating. The self-made entrepreneur takes massive risks because they are climbing the mountain. You cannot take risks because you were born at the summit and every single direction is down. Your entire job is defensive positioning. You spend your mornings running vector auto-regression models on the Bloomberg port system. You analyze the subtle appreciation of the Chinese renminbi. You watch manufacturing wage statistics in Shenzhen. You model currency hedges. You do all of this because a 2% slide in Asian markets can wipe out $40 million of family equity while you are eating lunch. You are paid an aggressive 7-figure base salary multiplied by a San Francisco geographic premium, solely to be paranoid. But your biggest risk is not the Asian exchange rate, and it is not the bond market. Your biggest risk is sitting in the family conference room. It is the 3rd generation. The founder, the grandfather who built the logistics empire, had calluses on his hands and a gut-level understanding of what a dollar cost. The 2nd generation, the current senior trustees, grew up watching him work. They respect the wealth, even if they never bled for it. But the 3rd generation, the cousins, the nephews, the 30-somethings, have never flown commercial. To them, the trust is just an ATM with no daily limit. Which brings you to Julian. Julian is 31. He is the eldest grandson. And Julian has just pitched the family council on a $150 million allocation to back his new agentic enterprise AI startup. He does not have a proprietary foundation model. He does not have a product. He has a 40-page slide deck stuffed with 2026 buzzwords like vibe coding, silicon-based workforce, and autonomous digital twins. He says he is going to eradicate enterprise work slop, and he has his grandmother's ear. $150 million. That is 7% of the entire portfolio. In an illiquid, unproven, hyper-speculative asset class. You run the Monte Carlo simulations. If this goes to 0, and the data says with cold, absolute certainty that it will go to 0, your 7.14% baseline yield requirement jumps to 8.2%. The compounding math breaks. The slow bleed of the Harrison fortune accelerates. You are already close to losing your grip on the principal, and this deal is the cliff. You take the red eye to Chicago to meet the two senior trustees. You do not meet in a commercial boardroom, and you do not meet at a public steakhouse. You meet on the third floor of the Chicago Club. You follow the strict dress code, tailored and conservative, jacket required, and you step into a private oak-paneled dining room sealed off from the outside world. Over a meticulously prepared piece of high-quality meat, you calmly, surgically lay out exactly why Julian's proposal will dismantle the trust within 12 years. You do not use emotion. You do not attack Julian's character. You just show them the math, the new OB3 tax liabilities, and the reality of the Delaware prudent investor rule. They taught you a lot of things in those Wharton executive sessions years ago: capital allocation, derivatives, portfolio theory. They did not teach you this. They did not teach you how to look an aging patriarch in the eye in a silent room and explain that his favorite grandson is a catastrophic financial liability. The full family council meets on a Thursday. Julian gives his pitch. He is charismatic, he is passionate, he talks about legacy and the future of technology. You sit at the far end of the mahogany table. You do not say much, you do not have to. The senior trustees vote the proposal down 4-1. Julian looks at you across the table. He knows you killed it. He looks at you not like a trusted advisor, but like an employee who forgot his place. You feel the temperature in the room drop. You have preserved the capital, but you have alienated the heir who will one day sign your paychecks. You walk out of that room feeling a very specific, very cold kind of isolation. You go back to your office. The fog has burned off. You look at the Bloomberg terminal. The number is $2,141,200,000. It ticked up a little while you were in the meeting. You did your job. The money is safe for another quarter. The trust is intact. But you sit there in the quiet, and you realize the ultimate truth of the family office. You are endlessly bailing water out of a boat that the passengers are actively trying to drill holes in. You cannot win. You can only delay the ending. You take a deep breath, you pull up the Q3 fixed income projections, and you get back to work. Thanks for watching. Please consider hitting like and subscribe if you enjoyed this video. Tell us in the comments what you'd like us to unpack next. See you in the next one.